Sandra was 44 years old when she did something she had been avoiding for almost a decade. She sat down at her kitchen table on a Sunday evening, opened a blank spreadsheet, and tried, for the first time, to calculate what her financial future actually looked like. Not what she hoped it looked like, not the optimistic version she carried in the back of her mind. The real version. She added up her savings, her 401k balance, her monthly expenses, and then she did the math on what her retirement might actually fund, not in years, but in months. The number she arrived at shook her. If she stopped working at 65 and lived, as the actuarial table suggested, into her mid-80s, she would need her savings to stretch for roughly 20 years. And at her current trajectory, the money would run out in 11, not because Sandra had been reckless, not because she had made catastrophic financial decisions, but because she had done what most working professionals in their 40s do. She had focused entirely on earning and spending, and had never built a single asset that earned income independently of her presence. If you are somewhere in your 40s or 50s, and you have never seriously confronted that calculation, this video is the most important financial conversation you will have this year. Because today, I am going to show you something specific and actionable: how to build a dividend portfolio from an initial investment of just $500. Step by step. No jargon traps. No unrealistic promises. A clear, proven framework for creating an income-producing asset that compounds in your favor year after year, decade after decade. And the final lesson in this video, the one most financial educators skip entirely, could be the single insight that changes the trajectory of your fiscal longevity forever. Do not leave early. Before we move into the framework, take one small action right now that your future self will thank you for. Hit subscribe, not because subscription numbers matter to a channel, but because what you are doing in this moment, choosing to spend your time learning how to build wealth rather than consuming content that leaves you no better off, that choice deserves reinforcement. Lock it in. And I want to hear from you directly in the comments below. 3 questions. Answer whichever one hits closest to home. Have you ever calculated what your retirement savings will actually last you in real numbers? What did you find? Do you currently own any dividend-paying stocks or funds? Even a small amount? What has been your single biggest barrier to starting an investment portfolio? Your answer is not just for me. It is for the thousands of people in this community who are in the exact same position as you. Drop it below. Let's learn from each other. Here is the financial reality that most people in their 40s and 50s are not being told clearly enough. The traditional retirement model, save in a 401k, collect Social Security, live off the interest, was engineered for a different economic era. An era of lower inflation, more predictable employment, longer corporate loyalty, and interest rates that actually rewarded savers. That era is gone. In 2026, the average savings account interest rate remains historically insufficient to outpace inflation. The purchasing power of money sitting in a standard savings account erodes quietly every single year, meaning that the person who feels safe because they have cash in the bank is, in measurable financial terms, losing wealth while they sleep. Meanwhile, inflation over the past several years has permanently restructured the cost of living for most households. Groceries, housing, healthcare, energy. The baseline cost of existing has risen in ways that have quietly and permanently outpaced salary growth for the majority of middle-income earners. The raise you received last year likely did not restore the purchasing power you lost the year before. And here is the compounding irony. In an environment where every dollar needs to work harder, most people in their 40s are doing the one thing that guarantees their money stays idle. They are waiting until they have enough to start investing. They are waiting for $5,000 or $10,000 or the right market conditions or the right moment That waiting is the most expensive financial decision they will ever make, not because of what they spend, but because of what compounding velocity they forfeit during those waiting years. Consider this. $1 invested at age 44 in a quality dividend-paying stock with dividends reinvested consistently has the mathematical potential to become $8 to $12 by age 65, depending on the growth rate and yield. That same dollar left in a savings account earning sub-inflation interest rates is worth less than $1 in real terms by the time you need it. This is the environment in which dividend investing becomes not merely attractive, but structurally necessary for anyone serious about fiscal longevity. $500 is not a small amount. In the right asset, deployed with discipline, it is the seed of something that could pay you for the rest of your life. Let us build it. Chapter 1. Start where you are, the permission you've been waiting for. The most destructive financial myth circulating in the 40-plus demographic is the belief that investing is an activity that begins with a significant lump sum, that you need $5,000 or $10,000 or a windfall before you have the right to call yourself an investor. Discard that belief permanently. $500, deployed strategically into dividend-paying assets today, begins earning income immediately. It begins compounding immediately. And perhaps most importantly, it begins building the investment identity and habits that will determine your financial trajectory for the next 2 decades. Here is what $500 buys you in the dividend investing world in 2026. A fractional share position in a blue-chip dividend aristocrat, a company like Johnson & Johnson, Procter & Gamble, or Coca-Cola that has paid and increased its dividend every year for 25 years or more. Or a position in a diversified dividend ETF, an exchange-traded fund that holds dozens or hundreds of dividend-paying companies simultaneously, giving you instant diversification and reducing single-company risk dramatically. You do not need to choose the perfect stock. You need to choose to begin. The investor who starts with $500 at age 44 and adds $100 every month will, in 20 years at a conservative average total return of 8%, accumulate a portfolio worth significantly more than the investor who waits 3 years to start with a lump sum of $5,000. The mathematics of capital deployment timing are unambiguous. Start where you are. Start with what you have. Start today. Chapter 2. The architecture of a quality dividend stock. Not all dividends are created equal. And this is where most beginning dividend investors make their first and most costly mistake. They chase yield. Yield, for those unfamiliar, is the annual dividend payment expressed as a percentage of the stock's current price. A stock trading at $100 that pays $4 annually in dividends has a 4% yield. Here is where the yield trap lives. A company offering a 12 or 15% dividend yield is not necessarily a gift. It is frequently a warning. When a company's stock price falls dramatically, often because the business is in distress, the yield appears to rise because the denominator has shrunk. This is what experienced investors call a yield trap, and it has erased the portfolios of countless investors who mistook desperation for generosity. What you are looking for instead is dividend sustainability. The 3 pillars of a quality dividend investment are: first, consistent payment history. Look for companies that have paid dividends without interruption for a minimum of 10 years. A 25-year unbroken record elevates a company to dividend aristocrat status, a distinction earned through multiple recessions, market crises, and economic disruptions. Second, earnings coverage. The dividend payout ratio tells you what percentage of a company's earnings are being paid as dividends. A payout ratio below 60% generally indicates the company can sustain and grow its dividend even during periods of reduced earnings. A payout ratio above 90% is a structural vulnerability. Third, sector resilience. Consumer staples, utilities, healthcare, and financial services have historically demonstrated the most durable dividend payment records. These are industries that serve needs rather than wants. They generate revenue during recessions precisely because people still need electricity, medication, and food regardless of economic conditions. Quality over yield. Always. Chapter 3. The Compounding Engine. How $500 becomes transformational. This is the chapter that changes how people think about small amounts of money permanently. Compounding velocity, the rate at which reinvested income generates additional income, is the single most powerful force in personal wealth creation. And it operates on a counterintuitive principle. The early years feel insignificant, and the later years feel miraculous. Here is a concrete illustration. You invest $500 in a dividend ETF with an average yield of 3.5% and an average annual total return, dividends plus price appreciation, of 8%. You add $150 every month without exception. You reinvest every dividend payment automatically through a dividend reinvestment plan, commonly called a DRIP. At the end of year 5, your portfolio is worth approximately $12,000. Modest, encouraging, but not dramatic. At the end of year 10, your portfolio has grown to approximately $30,000. The compounding is beginning to accelerate noticeably. At the end of year 20, when you are in your mid-60s, that portfolio, built from a $500 starting point and $150 per month, has grown to approximately $89,000. And it is generating approximately $3,100 annually in dividend income, passive income that arrives whether you work or not. This is not speculation. This is 8th grade mathematics applied to historical market performance. The variable is not market genius. The variable is time and consistency. This is income compounding working exactly as it was designed to work. And the only people who miss it are the ones who are waiting for the right time to start. Stop here for just a moment, because I want to ask you something that matters. Have you ever told yourself that you would start investing when things settled down financially, and then watched years pass without that moment ever arriving? If that sentence just described the last 3 to 5 years of your life, I want you to type the word waiting in the comments right now. Because here is what I need you to understand. The financial industry profits from your complexity. Brokerages, advisors, and financial media have a vested interest in making investing feel complicated because complexity creates dependency. The truth is that a dividend portfolio built on 3 or 4 quality positions or a single diversified ETF, funded consistently every month, will outperform the majority of actively managed strategies over a 20-year period. Simplicity is the strategy. Consistency is the edge. Type waiting if this is your moment. Let's keep going. Chapter 4. Diversification. Your portfolio's immune system. An investment portfolio without diversification is not a portfolio. It is a concentrated bet. Think of diversification as your portfolio's immune system. A healthy immune system does not rely on a single defense mechanism. It deploys multiple layers of protection so that when one system is stressed, others maintain the organism's integrity. Your dividend portfolio operates on the same architectural principle. With $500, diversification is immediately achievable through 2 vehicles. Dividend ETFs. A single share of a broad dividend ETF, such as the Vanguard Dividend Appreciation ETF or the Schwab U.S. Dividend Equity ETF, gives you exposure to dozens or hundreds of dividend-paying companies simultaneously. One purchase. Instant diversification. Ongoing professional rebalancing built into the fund structure. Sector spreading. As your portfolio grows beyond $500, begin distributing capital across at least 3 to 4 sectors. A position in a consumer staples company, a utility company, a healthcare company, and a financial services company creates a portfolio that performs with meaningful resilience across economic cycles. When energy prices stress utility stocks, consumer staples typically hold steady. When healthcare faces regulatory pressure, financial services may be thriving. The goal is not to own everything. The goal is to ensure that no single company's bad quarter can materially derail your entire income stream. Chapter 5: Market Downturns, the Dividend Investor's Advantage. Here is a perspective shift that separates disciplined dividend investors from reactive ones. For the majority of market participants, a market downturn is a source of anxiety, loss aversion, and portfolio abandonment at precisely the wrong moment. For the dividend investor with a long-term horizon, a market downturn is something categorically different. It is a sale on income-producing assets. When a quality dividend stock whose fair value is $100 trades at $75 due to broad market selling pressure, two things happen simultaneously. First, you can purchase the same income stream for 25% less capital. Second, your effective yield increases because the same dividend is now divided by a lower share price, giving you a higher yield on your purchase. This phenomenon, buying more shares at lower prices and locking in higher yields on quality assets, is one of the most powerful wealth accumulation velocity tools available to the patient investor. It is the financial equivalent of buying a premium property at a discount during a temporary market correction, and then watching both the value and the rental income recover and grow. The investor who panics and sells during downturns crystallizes their loss permanently. The investor who continues deploying capital, even $150 per month, during market stress emerges from every correction with a larger, higher-yielding portfolio than they entered with. Downturns are not interruptions to your dividend strategy. They are accelerants. And now, the lesson that most dividend investing content will never deliver, because it requires saying something that challenges the entire premise of starting. The most powerful dividend portfolio you will ever build is not the one you fund with $500 today. It is the one you fund with $500 today, and then continue funding with discipline, consistency, and structural intention for the next 15 to 20 years. Here is the truth about compounding that the numbers alone cannot fully communicate. In the early years, it will feel like nothing is happening. Your quarterly dividend payment will be $12, then $22, then $38. The portfolio will seem almost insulting in its modesty relative to the effort of attention and contribution you are giving it. This is the phase where most people stop. Not because the strategy has failed, but because they expected a sprint and discovered a marathon. The investors who succeed, who reach their mid-60s with a dividend portfolio generating $3,000, $4,000, or $5,000 per month in passive income, are not the ones who found a superior stock. They are the ones who stayed, who added to their position every month during the years when the numbers felt small, who reinvested every dividend automatically without a single moment of temptation to spend it, who treated every market downturn not as a threat, but as a scheduled opportunity. Fiscal longevity is never built in a moment of inspiration. It is built in the 1,000 ordinary months of discipline that follow. That $500 is not the investment. You are the investment. Start. You arrived at this video understanding that passive income matters. You are leaving it with a concrete, actionable framework for building a dividend portfolio that can serve you for decades, beginning with $500 and a monthly commitment that most people spend on subscriptions they have forgotten they own. The framework is straightforward. Start now. Choose quality over yield. Reinvest every dividend. Diversify across sectors. Add consistently. And treat market downturns as the wealth-building opportunities they genuinely are. Wealth is not built in moments of genius. It is built in years of discipline. If this video gave you clarity, share it with one person in your life who is waiting for the right time to start investing. That share could be worth more to them than any gift you have ever given. Subscribe to Hetty Invests, because next week we are going deeper. The 5 best dividend ETFs for beginners in 2026. The exact funds to consider when you are ready to put this framework into action. Your portfolio starts today. Let's build it together.